I would like to thank all of you for giving your time to hear us out for our monthly webinar. So the whole idea for this webinar is to give you a snapshot of how we look at the index and the sector for the month of May. How would you strategize yourself in terms of positioning for the month of May on the basis of the data, the key events you would look for, and what would be the best option strategy to work for in the current market scenario. Now, first of all, if you look at the market, that is the trend for the Nifty. Lately, it's been, I think, almost 8 to 10 trading sessions that we have been pivoting around the levels of 24,000. Now, the biggest suspense for the market is how the geopolitical tension shapes out, because really there is no clarity in terms of the data points and the actions and the reactions to most of the events. There are loose comments being passed. You have a day when suddenly there is a spike in prices, both in the international markets and on the domestic fronts, and managing positions in such huge volatile movements on an intraday front becomes challenging. If you look at the recent development, on May 6th, the US said that the war is almost on the verge of finishing off, and that this is where it ends. And probably what has happened after that is there is no still clarity that we have a closure to that situation, because there is volatility, there are reports of attacks, and such the markets are going to live on its edge in such a situation. Now, if you look at the Nifty, it's been trading in a range of 24,300, that has been the recent upside for the Nifty, and 23,800, that is the point where time and again some bit of buying demand has been seen in the Nifty index. So clearly it's very choppy out there. And if you are a positional or a trader with a weekly perspective on the Nifty, things are not so easy. It's becoming a challenge to make money in the market from a direction front. So what we are very clear in this month of May is that we are in a choppy, directionless market, and we should not be carried away by what the news has to say. At least on the positive side, if you were to look at for the market, really a closure to this war would, or till statements come out, still the markets are not really comfortable with the kind of volatility we have. There are talks of tariffs between India and US, which also might shape out well. The Bengal elections has gone in favor of BJP, and actually the market thought that the indices would get a thumbs up reaction to this, but unfortunately we had a muted start post the action. So really, as things unfold, one thing is clear, that we have to deal with this choppy situation. Now, data points, if you were to look from the month of May, what we noted in the rollover numbers was that there was a rollover of around 72% of long bets being carried forward to the month of May from the April series. Now, that's not very significant number, because in the prior month, the rollover was around 77%. So the positioning is not as strong as it was in the prior month. And considering the fact that we had a very strong recovery rally in the month of April, there is going to be slight hesitation in the market at the current market prices. So hence you see this choppy phase, where probably the market is in a phase of a kind of you can say it's taking a rest, a period of rest before the next round of momentum catches up in the market. Now, VIX, which is the volatility index, would hold the key in the short-term proceedings. Now, if you were to do a simple technical price analysis on the VIX chart, one important level which all traders need to note is the level of 16. Till VIX is holding above 16, there is a chance that VIX can flare up once again on any given day. And we are currently trading around 17. So we are at the support, but still not below the support. So it's a very close or a dicey situation, because the tendency of any financial product jumping from its support has high tendency, and hence the chances of a slight bump up in the VIX from the support zone is very much likely. So till VIX cools below 16, volatility is an important ingredient for the market. And if any bounce back from the current level in VIX is seen, then it would mean that there can be some bit of a corrective action in the market, because VIX and the Nifty are known to trade exactly the opposite of each other. There is an inverse correlation which exists between the Nifty and the volatility index. Now, as I mentioned, it's a choppy phase for the month of May. Really, if you are a trader, then you need to follow levels very closely. And the key levels, as I mentioned right now, based on the technical price charts, which is very evident to each and every trader out there, is the support of 23,800 and the resistance of 24,350 to be more precise. Unless and until we are breaking out of this range, we are not getting a clear-cut direction in the market. But let me tell you that within this range, how the open interest is placed, we are noting some bit of short additions. Let me tell you, yes, there are some short additions in index futures, which is slowly building up in the last few days from the FII side. So unless and until we are getting a clean close above the levels of 24,400, it's too early to say that the negatives are behind us and the market is getting into an upside trajectory. So still, I think it's the final leg of volatility which is still left in the market, and one needs to prepare themselves for this. And if you notice, always it's the bank Nifty which always takes the lead. It is the showstopper. It is what sets the trend for the market. And really, with the kind of slight negative price action which we are noting in the bank Nifty, it is still not very conclusive that the market is on a firm footing. Today's SBI results, stock down by 5 to 7%. Really, that doesn't bode well for short-term proceedings. If you look at the price charts and the derivative positioning in most of the PSUs and the private sector banks, they are running on a slightly negative tangent. It's only the mid and the small cap banking space which are garnering traction, and there's where the trading interest lies. Stocks like a Bandhan Bank, a Yes Bank, these have been laggards, and they are registering positive moves in the last few trading days. And these are the stocks which are standing out apart from the heavyweights in the banking pack. So clearly, we need that strong move from the banking heavyweights to support any positive traction, and that is not yet been seen in the market as of now. Even if you look at the options placement for the Nifty, normally we look at where the resistance is and where the support lies based on the highest open interest positioning. So for the 26th May expiry, which is the month-end expiry, still majority of the put writers are positioned at the strikes of 23,000 in puts, and in calls it stands at 25,000. So that is the 2,000 odd point range, which as an option writer, they are comfortably positioned, and they derive comfort in selling deep OTM options in case the volatility kind of breaks out from the current range bound scenario we are in. Now, the only risk to the market, what I see from the technical charts, is the level of 23,800 breaching if it does in the coming days. Now, really, we do not have any such news which would predict that, but one should be nimble-footed and ready to act in case those supports were to break. Because if you recollect, in technical analysis, chart gaps have a strong tendency to be filled. And there is a big gap which is seen on the chart right from the area of 23,200 to 23,500. And if we go by the gap theory, there is always a chance, which market has shown in the prior instances, that gaps tend to be filled. Now, whether this gap will fill in the month of May or in the next month, that the time is the best judge. But we stick with the levels and we do not predict that gaps may be filled immediately. Selling pressure will dominate market proceedings only if 23,800 were to break. So all of the traders need to draw this line very carefully on your charts, or note it in your book that 23,800 is the Lakshman Rekha for the market in the current situation. If it breaks, then there is something wrong which we are not looking at, and the prices have some different story to tell. And if that breaks, then probably we are talking about short-term negatives. Till then, the markets will be dicey, will be choppy, and clear buying will emerge only if 23,000 350 is surpassed on a closing basis. I'm repeating the levels again and again because these levels have to be memorized considering the current market situations. Now, the long-short ratio still is not improved. So, although you are seeing some bit of price positivity in most of the stocks, the FII positioning in the Indian market still are negative. In cash markets, you are noting sell figures day in, day out. In F&O market, selling pressure is there. There are only 13% longs in the system in the May series compared to around 87% shorts. So clearly the bias of the FII still are on the short side. And if you ask me who is supporting the market, because we do see some bit of buying traction, small and mid cap space is flaring all guns. The mid cap select index which we track, which has trading volumes in futures and options, is trading at almost at its life highs. So it is the DII money which is supporting the market, and that is where we are getting the cushioning part or the support in the market. It is the domestic funds which are driving or providing a support to the Indian markets. Now, key events which one should be looking forward to as we move into the remainder part of the May, one will be Q4 results. So although majority of the numbers have been behind our back, some more results are pending, which will eventually come out in the next few days. I think Hindalco, Dr. Reddy, if I'm not mistaken, I think Hindalco is the major mover, and some 3-4 other big names are yet to disclose their Q4 numbers. So that is the numbers you can look forward to. How the monsoon progresses is what we would keenly look forward to, because there are some initial reports that there may be slight delay in the Indian monsoons for this year. So that will have short-term repercussions on our market proceedings. Third will be the global Middle East tensions, and really that is some piece of news which we need to be watching every day, because crude oil is the crucial factor here. A couple of days back, we were staring at crude with $120. Now we are around back below $100. So the volatility is huge. Any news in the Middle East will keep the crude on a slippery footing, and that will dominate the market proceedings. Even the domestic rupee dollar situation will have its impact, because rupee is around the 95 odd levels, and that doesn't bode well for the short-term proceedings for the Indian market. So there, that cool-off is necessary. What the RBI will do to bring that cool-off is a question mark, because the CPI data which will be out, I think by next week, inflation data will have a lot to say about whether we are looking at rate cuts or not. But again, that rate cut or not will depend on how crude oil is playing out. So all these things are interconnected and interlinked, but the main news point which you need to look forward is how things are shaping up in the Middle East. And second, if you are believing in numbers, follow the crude oil. That number will, whether it is below or above 100, a simple benchmark will give some bit of comfort as to where you should be positioned in the market from a short-term perspective. Now, sector watch, really we have seen pharma sector blasting in the last few days. There has been strong traction on the positive side. Pharma was one of the sectors which had been hibernating for long, and suddenly it has come out with a bang. Strong breakouts have been noted in majority of the pharma names, and there has been strong long bets on the derivatives fronts in the May series. In fact, I am happy to say that we did come out with a pharma basket. Our technical desk has recommended the pharma basket a week back, that is the prior week, and I think we are 4-5% in green in the last few days with the runaway rally seen in most of the pharma names. Also, we have aggressively covered majority of the pharma names, be it our technical calls or in our derivative calls, and we have done justice to each and every up move which we have seen in the pharma names recently. We believe the same kind of momentum should continue in the pharma space, and this is the sector which you can keep on your watch list for trading. So the stocks with the best setups here in the pharma would be a Divi's Lab, second will be Dr. Reddy, third will be Aurobindo Pharma, fourth will be Torrent Pharma, and fifth will be Biocon. Whether you buy them at current market price, my answer is wait, go easy. There will be opportunities in the market. Slight dips of around 1.5-2% again will see buying interest in these names. So follow technical levels. We are there to provide you calls and as when the opportunity arises. But pharma is the sector to be long on in the month of May. Metals will be a bit volatile, but these are positively positioned, so you can watch for buying in this particular sector also, though the returns have not been that great. But I think from a buying perspective, if you're hunting for opportunities from trading, metals still are the stocks which are well set up for a bounce back on the technical price charts. Obviously, mid and small caps are the sectors one can be looking forward to, and we have captured some of the best moves in the market. The technical desk has captured strong moves in majority of mid and small cap names. So I believe if you are registered for our services, you must have seen the performance which the team has delivered. And I believe with the breakout which we have seen in the mid cap index, this mid cap select is traded on the futures and markets, options markets, and that index recently gave a positive breakout above the levels of 14,000. We did have an option buy call also recommended to play out this move, which played out very well in the last trading session where we booked out our profit in today's trade. And I think with that breakout, 14,000 now is a ceiling support for the month of May, and 14,700 to 14,800 can be the upside targets you will look forward to. So basically the whole idea is small and mid caps still have juice left in them in the month of May to perform better. So look out for opportunities in this space. We will tell you which stocks look good. Be alert on the calls which we recommend for short term, especially from the technical desk where they're aggressively covering this particular sector. We always make it a point to see that we do suggest an option strategy for all our option traders. And one asks me, how will you trade this market when the direction is choppy, when there is no clarity as to which way the market will open tomorrow, when news flow hits us and plays surprises day in and day out? One of the best strategies is the iron condor strategy. Iron condor is when you set a range in the market, and whatever happens to the market, our prediction is that prices should be confined to the range which we define in this strategy. So the broader range which we believe should play out for the month of May is the support of 23,200. That's our base support zone, and that would also mean the gap. In case the worst case scenario happens and the gap gets filled, then our support zone is 23,200 and the resistance is 25,000 on the upside. So with the range of 23,000 support and 25,000 call, these are the extreme end of the band where we feel Nifty may fluctuate, and we are recommending you to sell a put and a call accordingly. Now, once this band is set, to deal with the volatility within this band, just to play out any surprise moves, some statements may come out on the global front, and you might see some spikes in the market or a direction setting in if the shorter term range is broken out. For that, you are buying OTM 22,800 put and 25,300 call to kind of mitigate any surprise factor in the market. Or you can say that this buying of OTM options also would see that you reduce your margin requirement in this strategy to a great extent. So this is a classic iron condor strategy. I believe this is a very high probability of success. I think 75 to 80% is the probability of this strategy ending in profit for the month of May. And roughly you can target around 70-75 points in this strategy, which would mean that with a lot size of 65, we are looking for a rough target of around 5,000 on a rough investment of I think around lakh rupees in this strategy. So this strategy should bode well for the month of May. Around percentage-wise return, what you can expect is around 3 to 5% in this strategy. And if you were to define a stop loss where you feel uncomfortable, then 22,900 is the lower end of the stop loss, and 25,500 is the upper end of the stop loss. So just to sum it up, trading for May is not going to be easy if you are in index. be nimble-footed, be a short-term trader. We are there to give you calls to help you path or show the direction possibly where Nifty may head for the short-term scenario. But broadly, we believe Nifty may be confined in the range. The range right now which is active is the support of 23,800 and 24,300 on the upside. Whenever this range breaks, you can expect some momentum to catch up in the market, irrespective of whichever way it breaks. Right now, it's a neutral setup for the market. To play this neutral setup, we have given you the best of the strategy. It is going to be a stock-specific market because as of now, the broader market breadth is mixed. It is still positive. There are good opportunities in the market. So be tuned for the stock picks which we come out in our trading calls. And I think if the extreme range breaks, then the other supports which are looking at is 23,200. That's the worst case downside. And in case the resistance breaks on the upside, which is 24,350, which I mentioned, then 24,500 and 25,000 can be the upside which one can look forward to. So this is the broader frame of market which we are working with. I will open the forum for the Q&A session. So when we say working people, the main thing is, one is we have majority of our time which we devote to our work. We are not able to watch the market in and out. And with the kind of volatility which is there in the market, it's very difficult to place stop loss orders because things are changing day in and day out. So very rightly asked, how do you trade such markets? So I think the strategy which we discussed right now about an iron condor, where you define the extreme end of the market, you sell options there, and you buy OTM options again to hedge those risks. That is one of the best ways to approach this market. Because trust me, the way the markets have been moving in the 10 days, everyone has been scratching their head as to figure out where the markets might be heading, because we are used to volatility. Volatility has hit us hard in the last couple of months, and suddenly we are in a situation where if the markets are in a range and really the prices are not doing much. And when we devise strategies which set a direction, or we feel that it will go up or down depending on a personal view, and prices are not accordingly moving, it becomes a difficult situation to handle. So exactly that's the kind of a situation we are in. This might extend for this month of May, but overall a range bound strategy should do well. So I think for employed people, set option strategies where you define a range, sell calls and puts, but be sure that when you set a strategy of this front, also buy OTM calls and puts, because they will help you, one, reduce your margin, and two, also kind of cushion you against those nervous moments which the global tensions may have on the short-term prospects in the market. So with this strategy, I think you can be more relaxed and have a peaceful night rest and not worry about what's happening globally around with the strategy set. Yeah. See, swing trades basically are momentum trades, right? And the whole idea of swing trading is to capture short-term spikes in the market. It can be downside or it can be upside, depending on the opportunities presented. So this is exactly a market for swing trades. And if you were to ask me, how would you spot a swing trade? Now, clearly, if swing trades have to be spotted, I think on the price momentum front, you can look at moving averages, because they are one of the finest indicators which place you on the momentum front. So normally you look for crossovers. If you are an intraday trader, you can look at a 9 and 21 day crossover. That is setup one. A slightly medium term or a person with a 10-15 day view will look at slightly higher moving averages, like a 21 day or a 50 day kind of a setup. These are setups whenever this crossover happens, when the longer term moving average is crossing the shorter term moving average, that signal gets triggered. This is one of the best ways to stay with the momentum, and this is one of the characteristic of a swing trade. Now, to further validate this, you have to also see how the option chain is reacting to. Option chain basically says how the positioning stands in terms of open interest placement in the stock on the options front. So whenever any strike which draws the highest open interest, that notes shedding. Now shedding is where a person who's already sold that particular option suddenly gets nervous or is on the back foot because the prices are very close to where he sold his option. And once the price crosses his option, he starts bearing a loss. It comes to a point where he has to cover up his loss in the writing. And when he has to do that, is exactly he has to buy back the or buy his position which he has short sold in terms of the options selling. So this short covering normally fuels the next leg of rally. And since we are talking about a point where the highest open interest is, whenever a strike which draws the highest open interest starts noting shedding, there is good momentum which you can anticipate in the stock. So whenever you see such a phenomena happening, you need to see the next couple of strikes or next 3 strikes as to how the open interest is building up in all 3 of them. And if you see additions picking up, then that is a classic indication that writers are shifting on to higher strikes, shedding the current strike. And with a moving average crossover over, if you pile up, this simple setup works well for catching swing trades. So, if I were to put weightages to all these 3 factors, I think option Greeks are very important because, OI would tell you how the positioning is at a given point of time. What are the open positions? But really, they do not tell which side the open interest is positioned, whether on the buy or on the sell side. We generally draw conclusions that the open interest is positive, and we have to at the same time look at the price action to conclude that this is more of buying, but that may or may not really be the story, right? So that may give sometimes mixed reactions or movements in the market, because that is one of the most traditional approach where price is up, open interest is up, and we say it is buying. That's not always the case. Sometimes there are sellers which pile up at higher levels. So open interest and volumes, yes, they're important. They tell you which stock or where the index or at which point suddenly the participation has gone up. Participation going up is a healthy signal that people are more interested in trading the stock. But which way it will go, prediction is difficult, for which you have to rely on price and technical tools. But when you deal with derivatives, you have to know Greeks. Greeks are the most crucial element of an options. Now, just an example, when you buy an option, you need to know the volatility, you need to know the delta of the strike you buy. Normally at the money have a delta of 0.5. It means that if I'm predicting a movement of 10 rupees in the stock and I buy an at the money call option with a delta of 0.5, it means that if the stock moves by 10 rupees, my option price will move by 5 rupees. So accordingly, whichever strikes you choose, whether it is deep out of the money, slightly out of the money, knowing or having knowledge of delta is very important. Secondly, theta is the killer in most of the options, because there are times when you get the view right on options. You say that a stock may go from point A to point B. You predict the analytics right. That may happen as you decided. But if the time to reach point A to point B takes more than what you estimated, suppose you set the targets but you don't know till when that target would hit, then there is no point in trading in options, because there may be a case where if you set up the trade now and the target comes by the end of the month and you actually bought a strike where your target stands, then there may be a situation where your analytics was right, but because of the wrong choice of strike of the option, you are losing money in the option call buy trade. So we do not want to get in such situations. So knowledge of Greeks is very important. Unless and until you clearly understand how the derivative market operates, I think, go easy on it, because it's a leverage product, and at the end of the day, leverage product means you should be ready for big profits or big losses. It can hit you both ways. And normally we prefer buying options because that is one of the cheapest product to participate in. But every financial product, higher the risks, higher the returns. This is a low risk product because anyway, theoretically, the worst case scenario is when you buy options, you know how much you're going to lose. But the probability of you getting it right also is low because you are entering a low risk financial product. So you need to understand the laws, the rules of these games. So know the theta part or know the Greek part of derivatives. Then comes volume and OI analytics. So if you go to NSE website, on the NSE, they will give you a page which is read as option chain. On the left hand side, you have calls, on the right hand side, you have puts. In this option chain, normally there are different strikes which are available for trading, and there are different option prices at various strikes. And they will give an open, high, low, and close. They will give you the volumes in particular, each particular strike. They will give you an IV, and they will also give you as to the open interest, which are open positions at given point of time. This is the broader open interest or option chain which is presented to you on the NSE, which is dynamic and keeps on changing. Now, two important things which you need to know when you look at the option chain is where is the support and where is the resistance. To find the support, we see the strike in options which draw the highest open interest inputs. Normally, we assume that writers are smart, the HNI clients write options, and whenever you note a put having the highest open interest at a given point of time, we conclude that there are more writers present here, and we conclude this is the support of the market. Vice versa will be for the calls. So at the given point of time, if I'm saying 23,000 has highest open interest in puts for the May monthly expiry, it means majority of open interest or writing is positioned at 23,000. The writers expect the expiry for the month end to be about 23,000, for which they are writing options so that they can pocket in the premiums which is available at the strike of 23,000. Similar case for the 25,000 calls. So this is how an option chain is read. Now, for an intraday trader, what you have to look is how the action is playing out for at the money strike. At the money is where the spot trades. You have to suppose Nifty is at 24,000. You look at calls, you look at puts. You will have to see the open interest at both the strikes. And a couple of strikes before and after is what you need to keenly monitor. That is the open interest in the price. So if you come across a situation on intraday where the open interest is picking up traction in calls at the higher strikes and prices are also picking up, we normally conclude that is buying which is happening if the open interest is higher than what you see in the puts. And this is vice versa or the other end in calls also. So this is one of the indicators we try to see how the positioning is, but the right entry and the exit points are decided by technical analysis. So again, I'm saying when you trade derivatives, knowledge of technicals is a must, because derivatives will give you the positioning of the market. It will tell you how the positioning is, whether long or short in a particular stock or an index. But the fine tuning as to the right exit and the entry has to be done by technical analysis. So a mix and match of both these analytics is what is needed for succeeding the financial markets. Yes, of course, they do work. See, there is a lot of theory in the market, but the crux is always what is the trend you foresee. Unless you know the trend, strategy is the second part. You may set a range bound strategy like an iron condor which we discussed. But unfortunately, if the market sets in a trend, then your strategy is going to fail. If you are going to set a trending strategy like a bull call spread in a range bound market, obviously your strategy is going to fail. So the first point is analytics. Every strategy works, but understanding or analyzing the trend is what the key is. And that is where the entire game plan lies. So butterfly, box spread, all work. These do work. In fact, the probability of success or what most of the HNI clients do is the classic iron condor or the range bound box spread or the short strangles or straddles which we speak of, because the probability of success for such strategies is almost 70 to 80%. So hence these strategies are preferred because the success is high. But really, when you get them wrong, they will take away all the profits which you earned in that 7 situations. So hence, knowledge of a stop loss is essential. Knowledge of drawing your line, when to move out of the strategy is important. Or if not move out, you have to take help from registered, experienced analysts as to how best this position can be managed to play out the risk aspect. Let me tell you one thing, that setting a box spread or a short strangle is a no-brainer. Really, selling calls 2000 points away, 1000 points away, 500 points is what any person can set, because you know markets are not going to move beyond a certain point. But the real challenge is when the market moves, what will you do? Because if you just stay quiet and keep on watching, it is going to take out all the profits which you made in the last few trades. And trust me, there will be such days when it happens. For example, when the US-India trade deal was announced, we had a 700-point gap up in the market. What would you do if you were a call seller? You set a range strategy and you said these strategies always work. How will you deal when you sell an option for 10 rupees and suddenly it jumps to 100? So hence you need experts at that particular time when things go out of the hand, and how best you repair a strategy or how best you anticipate volatility is the key which stands when you devise any box or a butterfly spread. I think I just spoke about delta a few minutes back. Delta basically is more of, it tells you as to how an option price is sensitive to the stock price movement. That is what delta is. So when you go to an option calculator, against each strike price, you will come across delta. For example, let's say today Nifty is at 24,000. So 24,000 is ATM. And ATM always has a delta of 0.5, which means that tomorrow if Nifty moves from 24,000 to 24,100, it is a 100-point move in the spot. Now, if you buy at the money call 24,000, which has 0.5 delta, it means that that option will appreciate by 0.5, which is 50 rupees. That is what delta is. Suppose you would have chosen 24,500 call, right? And 24,500 is a delta of 0.25. Just an assumption I'm giving you. So if Nifty moved from 24,000 to 24,100, it is almost a 100-point jump. But 24,500 call, since it has a delta of only 0.25, your option price will just move by 0.25 of 100 rupees. So that is how a delta moves. And knowledge of delta before you choose the strike is very important, because these are all dynamic and these will keep on changing with the prices. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.